All right. Hello and good afternoon, everyone. Thanks so much for taking time out of your day to join us and learn a little bit more about this new program through USDA. So as Shannon shared, my name is Amanda Chang. I'm the outreach coordinator with the Carrot Project. I'm going to be going over in a little more detail on what we do. But I did just want to say quickly for those joining from all over the place, um, this program, Microfarm, I will be focusing mostly on Massachusetts, Connecticut, and Rhode Island in terms of dates and the prices of this insurance program. However, because this is a federal program, most of the details are going to be the same. And the CARE Project does have some resources available, and we'll be sharing some public resources for folks joining us from further outside of Southern New England. So just wanted to reassure folks who might be coming from outside of this area. So with that, I will start sharing my screen. Alrighty. Well, actually, oops, I need to bring this over. All right. Can everyone see this? Yes. Yeah. Okay, perfect. Great. All right. So welcome again to exploring USDA microfarm insurance in collaboration with our partners here with SEMAP. So this presentation is going to be quite a detail-heavy presentation. So please feel free to stop me at any point. I do encourage tons and tons of questions. We are going to be going through this at quite a fairly quick clip, but I will be doing my best to have plenty of time available for questions at the end. So with that, we'll get started. So a couple of tech check items. Shannon already did a lot of those, but if you're running into any like technology issues, just drop a chat message in there and Shannon will be able to help you out. And thank you for helping to monitor the chat and everything, Shannon. Great. So I also want to do a couple of funding acknowledgements. So the CARE Project, we are a nonprofit and some of our work is funded through the USDA Farm Service Agency through a grant with them, well, a cooperative agreement with them. And we also have a grant through USDA NIFA that covers our microfarm work. So thank you very much to both of them for helping to fund this work. Okay. And a huge thank you as well to CMAP, so our friends Shannon, James, Susan for inviting us here today. And I also want to thank a couple of our advisors who've been so instrumental in all of this. So Jeff Shazinski, Kian Dalzell, and Kevin Channel, who have been just enormous helps with putting this information together. All right, so the Carrot Project. So the Carrot Project, as I have said before, we are a nonprofit that supports farms for a number of different things focused around like finances and farm businesses. And so we do this through a variety of different ways. Our services are free or cost shared depending on the location or household income. Our goal really is to make financial services and business technical assistance as accessible to farmers as possible. And I think we actually have some folks here that we've met before, where it has worked before with the CARE Project. So hello and welcome again. We work with folks across Massachusetts, Rhode Island, and Connecticut. But even though farmers are the bulk of who we work with, we do work with food producers across the food system. So we work with fishers, we work with food entrepreneurs, some processors as well. So really anyone who is like a farm, agriculture, or a food-based business in this region, we will work with you. And so our services do include trainings and workshops, loan programs, one-on-one business advising, and coaching. And this is me. Hello, it's wonderful to meet all of you. So my specialty at the Carrot Project is supporting folks on the USDA program. So USDA can be a fantastic resource, but can also be quite tricky to navigate on your own. So that's what I'm here for. I can support with loans, disaster assistance, crop insurance. Individual support with me is no cost actually. So please feel free to call or email me at any point. And while I'm based out of Providence, Rhode Island, I do roam around the 3-state area. Okay, so today we are going to be talking about the microfarm program, but I do want to acknowledge there are plenty of other ways to build resiliency into your business. Crop insurance is just one of those options. We're going to be covering the Farm Service Agency disaster assistance programs very briefly as well, since they are another option through USDA. Self-insuring is essentially finding ways to keep resilient on your own. And I think that a lot of farms in New England already do quite an excellent job of that already. And then finally, there are also a lot of other supports through various state departments of agriculture. I know MDAR has a couple of programs. RIDEM has programs. Connecticut Department of Ag has various grants. Nonprofit organizations. So SEMAP is an excellent resource. If you're joining us from Western Mass, CISA has like emergency programs as well. So these are plenty of different options. So our goal here today is not to say like, oh, you should do microfarm. Our goal is simply to empower you with the knowledge to explore and consider these different options for building resiliency and risk management into your farm business. So we're going to be covering all the ins and outs, all the things to consider, questions to ask yourself as you're looking at these programs. Really, we want you to feel confident in your ability to make the best decision for your business. Okay, so let's get started. So I want to start by asking, how many of you here are familiar with crop insurance? Has anyone had crop insurance in the past or has an experience working with crop insurance? I'm seeing a couple of head shakes, seeing another head shake. All right, I'm going to take the silence and the fact that you're joining us here today as that you're looking to learn. You're here to looking to learn. So the other question then is, so let's not talk about crop insurance. How many of you here have experience with some kind of insurance, home, car, health, anything like that? Yes, right. I think at this point, everyone should be nodding. Everyone should be raising their hands. Yeah, I see your raised hand, right? So the reason I bring this up is because crop insurance, even though you might not be familiar with it, it's still a form of insurance. And because it's a form of insurance, there are many things about it that are similar to other forms of insurance that you may already be familiar with. So those things are, it costs money to buy into insurance, right? You have to enroll before the bad thing happens that you're insuring against. As with all other types of insurance, insurance won't cover everything either, right? Like my car insurance, it's not going to cover everything. My car insurance, I still have a deductible, same with healthcare or health insurance. But even though insurance costs some stuff, and even though insurance won't cover 100% of what I'm looking for it to cover, there are many aspects of my life where I can't imagine not having insurance, right? Like I can't imagine driving around with my car and not having insurance. I can't imagine owning a home. One day I'm hoping to own a home and not having homeowners insurance, right? Like, so I want to just start here by framing, even though you may not know crop insurance, you do know insurance and a lot of the principles are the same. So traditional crop insurance, what comes to mind when you think crop insurance? For me, this is what I think of, right? I think rows and rows and rows of corn or grain or oat or soy. And if you think that, I think you would actually be correct. So traditionally, crop insurance in the United States has been what's considered single commodity policies, which means that when you buy a crop insurance product, you are buying something to insure one specific crop. So that has meant, so in this example here, you can see corn. You would buy a policy that says, I am going to insure my corn for 150 bushels per acre. And if I don't end up producing 150 bushels of acre, let's say I end up producing 120, I can receive a payment to cover the difference between what I actually produced and what I ended up making. So this is how crop insurance has worked in the past. It's still how many crop insurance products work. And that is also like very much a simplification of how the process works. But because of the way it's structured, it has led to a couple of like unintended consequences. And so those consequences are, number one, it really encourages folks to like monoculture. So if I can only buy insurance for a handful of crops, why should I diversify outside of those crops, right? Like I end up wanting to just grow massive quantities of a singular crop. Another issue that, well, not issue, but consequence that arises is that lack of diversification, right? So it has unintentionally encouraged farmers to produce only a handful of crops, those crops being the ones covered by crop insurance. And finally, because it is yield-based, so let's say you do end up making that 150 bushels of corn. If the price drops, I'm still at a loss, right? If the price drops, I'm still not making as much as I'd hoped to make. But because these policies are yield-based, it doesn't account for changes in the price. And so this is where crop insurance has been. It's been like this pretty much for decades now. But let's take a look at some of the new things. So that's if your farm looks like that, right? Rows and rows and rows, hundreds of acres of a singular crop. What if your farm looks more like this though? So this actually is a picture of one of Carrot's clients. I believe it's a farm out somewhere in Massachusetts. But they are pretty much exactly an average farm that we see here at the Carrot Project, and I think is a farm that maybe you might recognize in yourself, right? So 5 acres, 10 or more different crops, making give or take $120,000 in annual gross revenue. What if you're a farm that looks like this? How can I make insurance work for me? That's when microfarm comes in. That's where microfarm comes in. So microfarm takes a look at the gaps that were left behind by the traditional crop insurance policies. And they say, okay, well, what if instead of ensuring the actual yield of my farm, the various crops, what if instead of doing that, I am going to insure the revenue itself? So under microfarm insurance, I'm going to say, okay, so $120,000. I'm going to insure myself for $120,000 in my coverage year. If I end up making, say, $80,000, I can then place a claim to make up the difference. So I can now put a claim in for $40,000. And what that means is the farmer can diversify their crops. They have now separated the insurance from their actual production. And what they're doing is they're really trying to encourage diverse farm operations. This program is an addendum to something known as the Whole Farm Revenue Protection Program. And that program is this as a parent, it's this one's parent program up to $17 million. And so microfarm, if you can think like $17 million, they're going to ask for a lot of paperwork and prove that your claim of the $17 million is real, right? And so microfarm insurance is like a simplified insurance process. Also keeping in mind that farms that are smaller scale don't have as much people power to be able to do all this stuff. So this is microfarm insurance, and this is what we're going to be talking about today. So very quick overview of what microfarm looks like if you are looking to enroll. So even though microfarm is a USDA program, it is a USDA crop insurance policy, all crop insurance policies in the United States are sold through private crop insurance agents. And so number one is you would need to contact your crop insurance agent before the growing season starts, right? So think about any other form of insurance. I can't buy car insurance after I have crushed my car, right? I have to purchase the car insurance prior to me getting on the road, prior to me potentially getting an accident. So same thing here with insurance. If you're looking to purchase insurance, you have to do it before the growing season starts. So sales close March 15th. That March 15th date is for Massachusetts, Connecticut, and Rhode Island. It is also for if you file your taxes by the calendar year. If you file your taxes, say, on a different fiscal year, or if you're coming from a different state, I would suggest either getting in touch with me or getting in touch with your local insurance agent for the dates for your place. So July 15th is when you would submit your revised farm operation report. I'm going to skip over that for now. August 15th is when you would pay the insurance premium. So you can actually enroll before you pay, because they understand that farmers, they're giving them time to actually be able to make some money from their farm business. So you wouldn't need to pay until August 15th. Notification of loss and then submitting of claim, we're going to cover in more detail later on. But this is kind of the overall like years worth of what this program would look like. So any questions so far? I know that was a really high level overview. Nope. Okay, so we'll move on. So to cover microfarm and the ins and outs of this, we've broken it into three main sections. So we're going to cover how coverage works. We're going to then cover how the premium works, and then we are going to cover how the claims work. So a little bit of insurance jargon. So throughout this presentation, I'm going to be using some of this insurance jargon interchangeably. Coverage to me is what I think of this as. But if I was an insurance agent, or if you go to an insurance agent, this is what they're going to be using. So they're going to be calling this a liability. So the liability is the value of what is insured, AKA how much you are insured for or how much you're covered for. Okay, so probably the number one question you have is, what can be covered under microfarm? So in terms of your revenue, there's going to be your approved revenue and then your non-approved revenue. And your approved revenue, the sum of the approved sources need to be $350,000 or less. You can make more than $350,000 gross for your farm. However, as long as you're able to pull out some of the non-approved sources. And so the reason for that $350,000 like threshold is if you make more than $350,000 from these approved sources, you would be kicked over to the whole farm revenue protection parent program. As I said earlier, microfarm, in exchange for like simpler applications and a little bit of reduced paperwork requirements, they only allow that up to $350,000. If you make more than $350,000, up to $17 million, they would ask for a little bit more information. And if that's where you find your farm, I would also, again, suggest getting in touch with me and I can walk you through the whole farm program. So on the approved side, what can you insure? So number one is agricultural products produced on farm. You can actually insure the resale agricultural products as long as it's less than 50% of total revenue. I think a pretty good example of this is, say, for your CSA. Sometimes farmers will buy in products from other farms. If like your CSA box ends up looking a little sparse, for example, that would be an example of that. I know like sometimes farm stands will buy in Christmas trees around the holidays to be able to have that as additional inventory. That's another example of like resale agricultural products, which actually is covered as an insurable thing. So the next two items, revenue from post-production processing. So freezing, drying, packing, canning is another good one, or the revenue from value-added production. So let's say like you are a berry farm and you also produce jellies from that, jellies or jams from those berries. That extra value that's created is coverable because, again, this is just covering the revenue of the farm. I really cannot emphasize like how huge of a change this is. So the post-production processing and value-added production, there is no other crop insurance product available that can cover those things. So traditional crop insurance and even the whole farm revenue program or some of the USDA's other disaster assistance programs, they do not cover value-added production. So again, I want to point this out because USDA is saying with this microfarm program, we recognize that a lot of very small-scale diversified farms are doing a lot of this post-production processing. So even something like bagging greens after you've like harvested your lettuce, something like that in other crop insurance products would not be covered. They are covered here, again, in recognition of how much extra farmers are doing when they're making less than $350,000. Okay, so on the non-approved side, so that would be timber, forest, or forest products. So forest or forest products would be things like maple syrup, Christmas trees, products like that. Animals for sport, show, or pets. So good examples of that would be like horses. Horses is one. Like dogs are another one. And then the last one is revenue from non-farm products. So things that you might be selling at your farm stand, but are not actually like agricultural products. So such as recipe books, tote bags, water bottles, those things would need to be pulled out of your revenue for the year when you're looking at that $350,000 amount. Okay. So now that we have covered the items that are or are not covered, let's talk about how the insurance company then determines how much of a value you can be covered for. And I just want to make sure that there's nothing in the chat.
Yeah,
Okay,
there's one question for you, Amanda. Can value-added products be covered if it accounts for over 50% of your total revenue?
Yes. So I think this one's going to depend, and thank you, Dylan, for the question. So I think it'll depend on if the value-added products are made from products that you produced on farm, or if they are made from ingredients that you purchase from off farm. I think, so let's go back to like the jams and jellies example. So let's say like I'm a berry farmer and all of the jams I create are from blueberries that I make myself, that I produce myself. That would be a different story than if I am producing value-added products and like a bunch of the blueberries are coming from off farm. That would change things around a little bit. Another thing to consider, and I don't want to get too far ahead and I also don't want to talk too much about taxes, but this program is based on the Schedule F tax form. And I think what may happen is if you end up having value-added products, particularly if their process be over 50% of your total revenue, the Schedule F may no longer be the tax form for you. It might be another tax form. So I know that doesn't quite answer your question. I think it's really going to depend on a couple of other variables. And without further details, that's kind of the general broad answer that I could give. Any other like follow-up to that? Okay, great. I'm going to move on then. Okay, so coverage. What is a coverage based on? So I like to think of the coverage as a scale. And if I was an insurance agent, I would be holding this scale and weighing two different sides of this farm's business. So on one side of the scale, they're going to look at your approved historic revenue based on at least the past 3 years of your reported revenue on your tax forms. As I just said in response to Dylan's question, usually they're looking for your Schedule F tax form. If you do not have a Schedule F tax form, they can take a substitute Schedule F, but it just needs to be able to fill in the same amount of information. On the other side of the scale, they're going to look at your approved estimated revenue for the coverage year based on your planned production revenue. So basically what that means is this. It means we're going to compare how much you've made in the past versus what you think you're going to make in the coverage year. In our case, we'd be looking at how much you plan to make in 2023. They're going to compare them, and then they're going to say, okay, which is the lower? The lower is the amount that we are willing to insure you for. So what that means is this. Let's say that I make $100,000 a year. Next year, I feel super optimistic and I have these like really cool new ideas in mind for how I'm going to do my production. And I have I'm just really, really, really optimistic that next year is going to be the year. And I estimate that I'm going to make $200,000. The insurance agent is going to say this, okay, great, like so great that you like have a really optimistic outlook and like so great that you have really strong business plans going forward. However, you can only prove that you've made $100,000 in the past. So because of that, we are only going to insure the amount that you can prove you've been able to make. On the other hand, so again, I've been typically making $100,000 a year. Let's say next year something changes. So let's say next year, I don't know, I decide to go back to school. So I won't be able to spend as much time on farm as I would like. Because of that, I only plan to make $50,000 a year. I cannot then go to the insurance company and say, hey, even though I only think I'm going to make $50,000, I would like to be insured for $100,000 because that's how much I've made in the past. It doesn't work like that. They're always going to take the lower of those two numbers. So another example here. So the average historic revenue is based on an average of at least the past 3 years. So let's take a look at this example here. So year 1, year 2, year 3, on average, have made $100,000. Next year, based on how my finances have been, I project that I will continue to increase my revenue. And so next year, I plan to make $120,000. Again, insurance company is going to look at this and say, okay, on average, you've only been able to make $100,000 in the past. So because of that, we are going to cover you for the lower of that. We are going to cover you based on your historic revenue. I see a question.
Yeah, Dylan has a question, and I have a question as well, actually.
Yes.
So Dylan asks, we will just have 1 year, 2022, of farm income tax history on a Schedule F form. Do we have to have this filed before being approved for our insurance policy?
Yes, that is correct. So for the 2023 coverage year, you will need at least 2020, 2021, and 2022. In your case, if you only have 1 year's worth of taxes, first of all, thank you so much for joining, and thank you everyone actually for being an early adopter to this. I can tell you that 3 years goes by really fast, and it's a good, knowing about this program ahead of time is really good so that you can prepare for this program later on. We are going to be covering a couple of options through Farm Service Agency, which is another branch of USDA that is available to farmers with less than 3 years of history. But yes, you would need the 2022 tax year filed before enrolling for the 2023 year. I see another question from Aaron. If you had 1 year above 350K, but your 3-year average and your estimated revenue for the next year are both under 350K, are you still eligible? Does 1 year above that line kick you up? So that approved revenue is a average. So if your average is above 350K or your expected is above 350K, that would be when you would need to kick over to the whole farm revenue protection. Again, though, you can pull out certain revenue from your gross revenue. So if that $350,000 includes some of those non-approved revenues, you would need to pull those out, in which case you may fall under $350,000. Any other follow-up questions about that? I hope that's clear. I know this is a lot of information and a lot of numbers, and we're just getting started. Yes, you need 3 years of history to be a part of this program. That is correct. Okay. So I'm going to move on. And Shannon, again, if you see a chat, just let me know and I'll pause. Great. Okay. So after they calculate the approved revenue, what's then going to happen is you're then going to select a coverage level, the ranges being 50% to 85%. So if you take a look at this, so in the previous example, the insurance said it'll be based on $100,000. So from here, my approved revenue is $100,000. So the highest coverage that I could get is 85% of that, or $85,000. And the lowest coverage that I could get is 50% at $50,000. So I'm sure at this point, you're probably thinking like, oh my gosh, like, so they're already taking the lower of my historic versus my estimated. And now they're like even covering not 100% of that. So I just want to pause at this point and say, again, this is an insurance product and insurance never covers 100% of your costs or your losses, right? Insurance is here to be a resource in case something bad happens. The hope of insurance is that you will never need to use the insurance, right? The other thing that I want to share is that crop insurance in general never goes above 85%. So those corn producers out in the Midwest, the highest that they are getting is also 85%. So as with some of the other USDA disaster assistance programs, I think some of the highest numbers for them is like 90%. So I just want to give that as a little bit of context, because I know like the first time I learned about this program, I definitely was like, oh my gosh, like it felt like the numbers kept going down and down and down. But I just wanted to share that information just to give kind of like the broader context of all of the different programs and all the different ways in which is covered. So again, it's not going to cover 100% of the losses, but it can get you through to the next season. And later on in the presentation, we're going to go over a couple of different scenarios to help you think of different questions to ask yourself as you're looking at whether or not this program is going to work for you. Okay. So for historic revenue, so I know I said that you need at least 3 years, but that revenue is actually based on a 5-year average. And so what happens is if you have 3 years of Schedule F, they will substitute your lowest number for the remaining 2 years. If you have 4 years of Schedule Fs, they will substitute the lowest number for the remaining year. If you have 5 years of Schedule Fs, you would use all 5. So like this slide here, you can see how that substitution works. So across the board, 90,000 was the lowest. And so they're substituting the 90,000 for the missing years. So that's how, like, if you think about this side, like the scales, that's how the left side of the scale works. Now let's talk about the right side of the scale. So the expected revenue, your expected revenue is going to be noted on something called the Farm Operation Report that is going to be part of that initial insurance application and enrollment. And what it's saying is, this is what I plan to reduce. And then based on how much I've made in the past, this is how much I expect to make in the coverage year. So for micro farm, they do allow what's called a consolidated estimate. So you do not need to break out like individually, like, okay, for my lettuce, for my tomatoes, and for my carrots, I expect to make this much per each crop. They do allow you to bunch together your estimates based on like your previous years and based on what you've produced previously compared to what you produce now, and give an estimate here. Most of the time, I think people are trying to make more in the next year than they made in the past. So I think usually it's going to look, your number is going to be based on your historic number, but this is part of that scale balance, right? So that's how the expected revenue works. So I'm sure looking at the slides that go over like how the substitutions work and how the coverage works, like these 3 questions are probably in your head, because these are the 3 questions I had in my head when I looked at how this program works. So number 1 is, what if I had some bad years? I don't want those bad years to drag down my average, right? Similarly, what if I steadily increase my profits? So in the case of, like, let's say every single year I've just been doing better and better, I don't want those early years because I made less, even though I've been doing better and better for my farm business. I don't want that to drag down my average. And the last one is, well, gosh, like, how am I supposed to know in March exactly what I'm going to be producing for the year? Like, things happen, farmers adjust, they adjust their productions as the year goes on, right? So there are a couple of adjustments that are available to help kind of like massage the numbers and curve the numbers in favor of the farmer. So indexing is something that is available to curve the number up if you've been steadily increasing your profits and your revenue year after year. Substitution, exclusion, and CUP, those are different options available to farmers in order to like drop bad years or to take a portion of the bad year or substitute in a different way. All of these different adjustments we're going to be going over later with numbers so you can see like how much of a difference it can make. And then finally, so if you think back to that timeline that I showed, in July, there is going to be an opportunity to revise the numbers. So there is going to be another chance to change what you expect to make. Okay, all right. Any questions so far here? I know that was quite a fast overview of how the coverage works. How are people feeling in general? Well, I'm going to assume that people are feeling good. I'm just going to keep going ahead then. Okay. So, so we're now going to talk about the premium. So premium may be a more familiar term if you used other forms of insurance. So premium is the cost of the insurance. So it's the amount that you pay out of pocket to be able to enroll into this insurance program. All right. So how do they base my premium? Or what do they base my premium on? I will say this is probably the number one question I get is how much it will cost my farm to be able to enroll in this program. So this premium is composed of two parts. So the total premium cost is based on the producer's premium and then a subsidy from the USDA. So the producer premium is the amount that you need to pay out of pocket. The subsidy is the amount that the USDA pays because they're looking to encourage farms to build risk management programs into their farm businesses. So on the producer side, how much you pay is going to depend, number one, on how much you insure. So how much I can expect to pay if I'm looking to cover $50,000 versus if I'm looking to cover $350,000 is going to be quite different, right? The level of coverage. So if I'm looking to cover 50% versus 85%, 85% is going to cost me a lot more than if I want to cover only half of my revenue. And finally, the county that you're located in is also going to impact the premium. I think that the county you're in impacts it the least from what I understand. But they do, basically it's saying that some counties they've deemed like somewhat riskier to grow crops. So like I'm based out of Rhode Island, some of the coastline areas that might flood or might be at risk of hurricane, they might say, hey, like this might be a little riskier. We're going to ask you to pay a little bit more. So on the subsidy side, so USDA will pay that subsidy as long as you are compliant with conservation measures in your area. And we're going to cover what form that is later on. So this premium does need to be paid by August 15th of the coverage year. I do want to make a note here that if you qualify as a beginning farmer, which means that you have less than 10 years of being the primary farm operator, or if you're a veteran, those farms are eligible for premium reductions. So that's definitely something that I encourage you, if you're interested in this program, to let your insurance agent know, because they will be able to help bring down the cost out of pocket. Okay. So that was the premiums. Now we're going to cover how you would put in for a claim. Okay. So I've been using the word claim, but the actual insurance term is something called the indemnity. So I put in a claim, and then the payment that I get back is the indemnity. So the value of the payment for an insurable loss. So what does notifying for loss look like, and how would I place a claim? So the first thing to be aware of is if you enroll in the microfarm program, you would need to notify your insurance agent of that loss within 72 hours. So what this can look like is this. So let's say, let's take a look at like this tomato here. So let's say it's been raining a bunch the past couple of weeks. And today I walked through my fields and I noticed that my tomatoes have split. As soon as I notice that the tomato has split, and so because it's split, now it might not be as marketable. So I expect to make less for this tomato, or expect to need to not be able to sell this tomato at all. And so I think that this may impact my bottom line at the end of the year. I would immediately call up my insurance agent and let them know, hey, I've had a bunch of split tomatoes. I think it's going to impact my revenue. Here's a picture. So so when you notify that insurance agent, you want to prepare to prove your claim. So what that means is they're going to ask to see production records, financial records. They're going to ask to look at sales records. They may also send an insurance agent out to the field to make sure that like what you say you're claiming for actually happened. So I like to use the example of like car insurance, for example. So let's say I'm like driving somewhere and I crash my car. I for sure would let my insurance agent know as soon as that accident happens. Because if I wait too long, the insurance agent is going to come back to me and be like, Amanda, how do I know you're not just like a terrible driver and you just like drove into your garage door and now you're trying to pass it off as something else, right? It's still an insurance company. It's still a private insurance company. And so similar to needing to prove my claim, right? I would need to submit like a claim. I would need to say, I would probably need to send in a picture of like the damage done to my vehicle, maybe like a witness statement, something like that. So again, you would need to prove your claim because the insurance agent, they want to protect against bad players and they don't want to be like, they don't want insurance fraud is what's really going on here. I would honestly suggest to folks that you take pictures for yourself. I think it's pretty good policy, whether it's for a USDA insurance program, whether it's for disaster assistance. I just really would strongly encourage you to take pictures of potential sources of loss. Since it's something that USDA, for example, USDA can also come out for a claim for disaster assistance programs. USDA will also ask for pictures. I just think it's always a good policy to just take pictures on your own. So other good examples of loss. So let's say it's like April or May, and it's just been pouring and pouring rain. So because of that, I've actually been prevented from planting as early as I would have liked because I can't plant because my fields are way too wet. That would be another thing that I could put in a claim for because my fields are too wet, I start planting later than expected. So because of that, I expect to produce less than I had originally planned for. That is another thing that you could place a claim for. In that case, you would call up your insurance agent, say, hey, it's been pouring rain. They could come out and see, yep, ground's too wet. But that is also another thing that you could notify for loss. So anything at all that you think could impact your revenue at the end of the year, notify your agent. So the other thing to know is there is a lag to receive claim payments. So because this is a revenue-based program, you won't know how much your whole year's worth of revenue will be until the year closes out, right? So that is something definitely to consider when looking at this program is the lag time between when your loss happens and when you receive the claim. So for 2023, what's going to happen is you're going to enroll by March 15th. December 31st, 2023 is when the coverage year ends. And so, well, actually, yeah, and it's because that is like your year's tax. So you're filing by the tax year. So in 2024 is when you would submit the final claim paperwork. And 2024 is when they would give you that claim payment because similar to how I need to give my taxes to the insurance agent to be able to determine how much my revenue was when I'm enrolling, they're going to take a look at your final taxes for the year to determine whether or not you ended up making the insured revenue amount. So just be aware that there is going to be a bit of a lag between when the loss occurs and when you would receive that payment. And then just another note as well, that there is auto enrollment between years. So if you enroll 2023, you automatically be enrolled for 2024. That does not mean that you have to enroll. It just means that they're trying to save a little bit of paperwork. They're going to automatically enroll you. If you don't want to enroll, you can elect to opt out of the program. So it's not like if you sign into this, you're stuck into this forever. I see a question here.
Yes,
Would it be
question
likely
about agent site visits. So Dylan's joining us from Nantucket. How likely is it that an agent would take a boat and rent a car to make a site visit, or would pictures suffice?
Got it. So I think that is probably going to depend on your agent and it's going to depend on the particular claim. So each insurance company is going to be pretty different. And I think each claim is also going to be different. So I think if you were, so I'm not going to answer that. Actually, I think it's going to depend on the company itself. And I think it's going to depend on the nature of the claim. Yes. I will be talking a little bit later on, some tips for how to work with an insurance agent, and just some best practices that I think that folks should know if they're looking to work with an insurance company. So hopefully that will also that discussion will cover some of these questions. So I see another question here. We often deal with slow rolling disasters on the farm, drought, or year too much water. Imagine it can be hard to pinpoint a moment of loss to notify within 72 hours. Some of those situations, maybe pictures of dying crops on a particular day, but at the end of the year, you see the revenue is down after a long dry spell. How do things like that work? That is a really, really good question. So I think that will also depend on the insurance agent. So I keep mentioning the insurance agents because even though this is a USDA program, it is still administered through these private agencies. And so because of that, I think like each agency's standards, each agency's like how they're going to look and like interpret the USDA policies is going to be a little bit different. I think it'll also depend on the crop itself. And so something like that, I would really suggest like talking or asking questions of the insurance agent. Hey, these are the crops that I grow. This is how the production ends up working out. And these are the things. When should I notify you, or what conditions should I be notifying you for? So for this program, that's what I would suggest. So I am going to just jump ahead a little bit. So I know 72 hours does seem like a really short time period, and I totally agree. I think if you experience something like farmers are really busy, I know there's a million other things happening, and especially if you notice something that's like a really big loss, like notifying your insurance agent may not be the first thing that comes to mind. That 72 hours is not unique though. So if you were to do some of the USDA disaster assistance programs, some of their reporting time periods are also 72 hours. So I really like encourage people to think of it in the same way that you would think of any other insurance that you do. So like car insurance, for example, this is an insurance product. And so because of that, the insurance agents, they want to be able to make sure that your claim is as you say it was, and that you're not submitting a claim for something that was actually in your control. Yes.
Amanda, can I ask before you move on?
Yep.
Do the insurance agents who deal with this program, do they ever take any stock in, FSA disaster declarations? I know most of Massachusetts counties were under a disaster declaration this year because of the drought. Is that something that could help out farmers for some of these, slower losses that don't, like Erin was saying, have a pinpointed, this is when the damage happened situation?
Yeah. So that's a really good question. I'm actually not sure the answer to that question, but I can definitely follow up. I can definitely follow up with that. So let me just note that down.
While you're doing that, we do have another question in the chat. So Hannah asks, my farm is located in 2 states, Massachusetts and Rhode Island. Would I be able to be insured as one farm, or is each state handled separately?
Yep. So that is a really good question. That is something that I'm also unsure of. I think it depends. I think it depends on like how exactly that's structured. So sometimes folks will have like parcels in different states growing different things, and they'll actually be like separate businesses versus like if it's all under one business, because a lot of this does come through the farm tax, like the Schedule F tax form. But that is a really good question. I will follow up on that as well. I did actually have someone ask me that on Saturday as well. So I'll add this to the list of questions. I do want to share that micro farm, this program is new as of 2022. And in fact, this information did not come out until October 2022. So thank you again to everyone for being an early adapter. Thank you for joining us and learning about this program ahead of a lot of your peers. I think it's a really exciting program, but because it's so gosh darn new, a lot of these questions have not yet been answered by by Risk Management Agency, which is the branch of USDA that releases these policies. And because of that, a lot of insurance agents as well are also trying to learn about this program. So that's a very long-winded way of saying that this is all very new. These are all very good questions, and I absolutely will follow up and get answers to everyone. Another question here. If a farm is enrolled in microfarm insurance, can they still be eligible for USDA disaster assistance programs? Yes, that is correct. So if you are enrolled in microfarm insurance, you are eligible for the disaster assistance programs such as the NAP program, ELAP. And so like a good example of when you might want to do both. So microfarm insurance covers your whole revenue, right? But if you have a particularly high value crop, you may want to consider enrolling in one of the disaster assistance programs specific to that crop. So, let's say, for example, I'm just going to keep going back to the blueberry example. So let's say like I grow 5 different crops and my highest value crop is blueberries. So let's say like there ends up being a drought and I lose my blueberries, but my other crops are pretty drought resistant. And in fact, they actually end up doing really well. So what ends up happening is even though I lost my blueberries and the rest of my revenue was able to make up for the revenue loss. So in that case, I actually can't place a claim at all for microfarm because the revenue, the harvest of the other products has actually made up for the loss in the blueberry. The USDA disaster assistance program, because they're buying this specific crop, I could then place a claim if I was also enrolled in the disaster assistance program. I could place a claim for that specific crop and be able to make up that difference. So definitely at the end, when we talk about question and answers, we can go through a couple of different considerations and we can go through a couple of different scenarios of how you might want to like mix and match these different programs. Great. Thank you for all these great questions. And any other ones while we're paused here?
I have a quick question.
Yes.
Which you may have already gone over, but if we currently hold insurance through something like Farm Family, as far as like switching from one to the other, I don't know if you have any advice on that or what that will look like.
So is that insurance, may I ask, like, what is it covering? Is it covering the crops themselves?
No, it's not crop insurance, it's farm. Like we have market insurance and farm insurance.
Okay.
I don't know a ton of that and that about it.
Got it. Yeah. So for microfarm, if like so general liability insurance, just general insurance is for the farm.
Yeah,
you can
that's
have
totally
that
separate.
Yeah, so you can be enrolled in that as well as the microfarm insurance because they're covering different things, right? So the microfarm insurance is covering the crops themselves.
Okay.
Your other insurance is covering just your general business. That being said, so in exchange for microfarm being like an easier and simpler application and less paperwork that they require, you cannot enroll in like individual crop policies. So let's say like on my farm, I have apples. And my apples are a very high value crop to me. If I have microfarm insurance, I cannot also have a apple crop insurance program. I can have those apples be part of a USDA disaster assistance program under NAP, but I cannot have another crop insurance like specifically for the apples.
Okay, so my thought is comparing it to like GAP versus CQP as far as like food safety. Does that like one's like a big program and the other one's more like a specific and less paperwork program?
I'm not quite understanding the metaphor with like.
Oh, okay. I was just thinking like as far as food safety, like following the good agricultural practices versus the Commonwealth Quality Program, which is more like local, smaller Massachusetts program, I think.
Okay. Yeah. So I think maybe the question is like when is it better to go like how do these programs work in tandem with each other and like how would I know which one to go with which? Is that kind of
Yeah, I guess I'm just like zooming out and looking big picture about like what is necessary for a small farm.
Okay. So let's hold off on that question. Let's go back to that in the very end. I think, yeah, let's hold off on that question. I want to get through this and then we can talk about like things to consider, questions to ask yourself in your farm. I also want to be cognizant that we're at the hour mark. Do folks want to take a break at all? Like a couple minutes break?
I say, let's keep going.
All right, great. Thank you, Susan. We're just gonna keep moving ahead then. All right, cool. So we just covered, so we've covered what is covered. We've covered how to place a claim. Now let's cover what is not insurable under crop insurance. Basically how I think of this is, even though this is a different approach to crop insurance, it is still crop insurance. And so it is insuring the crop itself, but it is not insuring the business. In addition to that, they cannot guarantee that your business is going to be profitable. They cannot guarantee that your business is going to make revenue. And they also cannot cover what they consider to be like business management or business decision making. So things like labor shortages, inability to market, lack of sales, those are things that would not be covered by crop insurance, even though they absolutely would make an impact on your revenue. So crop insurance, basically how to think of it is like, whatever you're claiming for needs to be something that is typically weather related, but it has to be something that the insurance agent considers outside of the farmer's control. So if my field floods, if there's a drought, if there's fire, if there is like hail, those things are things that are not in the farmer's control. But things like labor shortage, even though like I totally understand, we are just at a really tough time now, and a lot of farmers are really lacking in terms of labor. That is something that the insurance agent could say, like, hey, you know, that we consider that to be more about like how you're managing your business. How do I know that maybe you're not just managing your business properly, or things like that. So labor shortage and ability to market, lack of sales, unfortunately, is not covered. The other thing that is not covered is any damage caused by humans. So this picture here is of ATV damage in fields. So in this case, the farmer could not, so this is outside of the farmer's control, right? Like they didn't have anyone, they did not ask for anyone to drive through their fields with ATVs. But something like this, it's damage caused by humans. This would be more like what Sarah is talking about in terms of like general liability insurance. Maybe there's like some kind of civil damages that you could get from whoever drove through your fields. Any damage caused by humans, unfortunately, would not be covered by crop insurance.
Couple questions. One, what about a pandemic? So Elise asks a good question about what about sales outlets like farmers markets being closed due to a pandemic?
Yep. So that was one of the questions that we asked of our contacts at the insurance companies. And they honestly, they waffled on that answer. I think they were reluctant to say whether or not they would cover it. And so that kind of goes back to an earlier question about like, how would they consider it? Or like, would this be coverable, or would they not cover it? I think it's going to be up to the insurance agent ultimately whether or not they accept the claim. So even something like, oh, my field floods, I think that I couldn't have planted on time. They're still going to review that claim and like decide whether or not they're going to accept the claim. So in the case of the pandemic, we did ask that question and they were reluctant to say whether or not they would take it. So I'm just going to like share and pass that information along. Okay, I'm just
And
going to take a
Sarah
look.
asks, would this include if a greenhouse was damaged in a winter storm?
Yeah, so something like that, absolutely, because the winter storm was like, you can't control the weather. And so now your winter storm has damaged your greenhouse isn't usable anymore. Absolutely, that would be like a good example of something that you could file a claim for. Any other questions? Nope. All right, we'll keep
Oh,
moving
Susan
forward.
has a
Oh,
question.
yes. Hi, Susan.
Hi, just jumping off that last one. So, if you file a claim because you lost your greenhouse, you're not getting the money to rebuild the greenhouse. You're getting money for the revenue you lost from the greenhouse. Is that accurate?
That is correct. Yes.
Okay.
So what it's going to look like is this. So let's say like you have, I don't know, like seed starters or something in your greenhouse, and you've lost all of them because the roof just came crashing down. Well, actually, no, it's a winter storm, so I don't know why you have.
My greenhouses are full of greens and I'm selling at winter markets.
Okay.
Really
Yeah. So,
correct.
okay. Yeah. So in that case, so if it's full of greens, what's going to happen is like you've lost all those greens now because let's say like the greenhouse crashed, they've been exposed to frost. All of them have now been lost. So yes, it would be for the revenue of the amount that you've lost in there, and then the amount of reduced production because now you don't have that as a source of production. But in terms of covering the actual greenhouse, other programs would be available. So like USDA has, I think they have some like emergency programs to cover repairs to your farm. They have programs available to cover other damages like that. There are other programs that would be able to cover the greenhouse itself and the repairs to the greenhouse. Yes.
So in filing a claim, take photos of the damage to the greenhouse itself, but also the crops inside, because that's what's being, okay.
Yeah.
And Hannah asks a good question about crop loss to deer damage. Is that covered?
Yep.
Huge problem for everyone.
Yes.
In
Yes. So unfortunately, animal damage is not usually covered by crop insurance or by disaster assistance. And the reason for that is because they're going to say, well, maybe you could have put up fencing. The other one that I get questions about is like birds coming in and eating my crops. For that, they could come back and say, well, could you put up netting? So unfortunately, like, I think how to think of it is like the insurance company is going to ask, were there ways that you could have prevented this, or were there possible ways that you could have mitigated it? Something like weather related events that is truly like outside of the farmer's control. And so those would be the ones that they're willing to cover. What if you have deer fencing, you still lost crops to deer? Again, for that, I unfortunately, they would not cover it. So even like insects, I know insects is one that can be a little dicey. So like if you lose your crops due to insects, you could argue that it was because of like climate related things. Maybe it was a very humid summer, or maybe it was quite warm. And so because of that, like certain pests came about. As long as you can tie it to a weather event, you can usually get it covered. If you cannot tie it to a weather event, you cannot be covered. That's probably the better way to summarize this. If it can be tied to weather, covered. If you cannot tie it to weather, not covered. Would it cover crop loss due to drought or flooding due to weather if we do not have a well to irrigate from? Yes. Yep. So drought or flooding, yes, for sure. That would be coverable.
one other deer question that I think I know the answer to, unfortunately, but so increased deer pressure due to drought. If you can tie it to there's less forage for deer, so there's more deer pressure on my irrigated farm, could that be covered?
That's a good question. That's a good question. For that, I think that's something that I'm going to keep going back to. I think it will come down to what the insurance agent thinks.
Okay.
For the insurance agents, again, like we'll be talking a little bit about how to work with them. At this point, I think I might as well just share, like, there are ways to appeal a claim. There are ways to to like say, hey, I don't think that your judgment was correct. I think the main thing is, even if you think, or you're not, so if you're not certain, or you think you might have a chance, put in for the claim. It's better to put in for a claim and notify for loss than to not do it when you could have gotten something for it. So just kind of like something that I would suggest for folks. So I'm going to just keep moving forward because I do want to make sure that we cover everything, but I am hoping to have plenty of time available for questions. Okay. So we just talked a lot about microfarm, and I know that was a crash course into this program. As I said earlier, like, I am here to help answer your questions and to help you decide whether or not this could be a viable option for you. If you decide, you know what, I'm not ready, or hey, I'm not currently eligible, what other risk management options are available to you as a farmer? So we've already mentioned this a couple of times, but Farm Service Agency has a number of different disaster assistance programs. So the nice thing about disaster assistance programs is from day one of farming, you are eligible. So they do not require you to have a certain number of years of prior history. From day one, you are eligible for these programs. In exchange for some of the benefits of disaster assistance programs, so some of the other benefits include, depending on the program, you may not have to pay anything to be part of the disaster assistance program. But in exchange for these different things, there's a little more variability in what's available. So the program availability does change county to county, crop to crop. So what that can mean is some programs under disaster assistance are available all the time. Some programs are available only when a disaster designation has been like designated by the Secretary of Agriculture. Some programs require prior enrollment. Some programs are an as-needed basis. Really, each program is going to look very different, and not every county is going to have that program be available to it. So there's a little more variability in some of the disaster assistance programs. If you are interested in disaster assistance programs, our number one tip is we just recommend that you register with your county FSA office to stay in the loop. So when you register for yourself, if there's any changes or any programs suddenly become available, you will know, and you will be able to know when those programs are available. So like a good example, so in Rhode Island, I think a number of years back, all of a sudden there was a random asparagus program. And if you were registered with your county Farm Service Agency office and you grew asparagus, they could reach out and let you know, hey, there's now a program available for asparagus farmers. So that's what I mean by these programs. The availability changes, and it differs county to county. So just as with crop insurance, it will not cover 100% of your losses, but it can be enough to get you through to the next season. So let's take a look at some disaster assistance programs here. So you've got the NAP program, ELAP, which is the Emergency Assistance for Livestock, Honeybees, and Farm-Raised Fish. Tree Assistance Program, I want to specifically call out the Tree Assistance Program because microfarm does not cover timber, forest, or forest products. They would be covered under the Tree Assistance Program. So that Emergency Conservation Program, so like that greenhouse that suffered losses because of a winter storm, the Emergency Conservation Program could be a program that you would tap into to help repair the greenhouse itself. Livestock indemnity, livestock forage. So these two are good examples of programs that only kick in if your county has been designated a drought. So NAP and ELAP at the top, those are available anytime. Sorry, not available anytime. Those are available every year. Livestock indemnity, livestock forage are only available if your county has a drought for a certain amount of time. So I just want to highlight this here, like these programs will change. And I think the best thing to do if you're interested in is to just learn about them ahead of time and to register your farm so that you stay up to date if there are any changes or any programs suddenly become available. The NAP program is very similar to crop insurance in that you would like enroll in the program before the growing season, notify for loss as it occurs, and then receive a payment if there's a disaster. The ELAP program is an as needed, so you do not pay ahead of time. And what happens is you simply notify for loss throughout the year, and you can receive a payment once you like go over a certain threshold amount. I see a question in the chat. We are in a 100-year flood zone. Will this preclude our eligibility for the program? For the micro farm program? Or like which program? Yes, okay. Yeah, so the 100-year flood zone, no, it would not mean that you are not eligible for the program. Like every farm, as long as you meet the other eligibility requirements, are eligible for this program. And in fact, if an insurance agent gives you a hard time because they think you seem to be a risky farm or something like that, they cannot do that. They are legally required to sell you and enroll you in this program. So that's one of the differences in this insurance program compared to other insurances, is that like this is still a USDA program, and USDA wants to be able to like help farms stay farming year after year. In this case, what might change is your premium might be a little higher because they may consider you a riskier piece of farmland. But no, you would not be ineligible. You just might have to pay a little bit more. But like the amount that you would need to pay, like we absolutely can go over that for everyone individually, and I'll show you how to calculate out your costs later on. You're welcome. Would livestock indemnity cover loss due to bird flu outbreak need for culling? Livestock indemnity, I don't think covers poultry, but well, I can't remember. I don't remember if it covers poultry or not. But yes, it would cover something like that. Yes. So like ELAP, for example, would also be able to cover that. Great questions, everyone. All right, so I'm just going to keep moving forward, and I'm going to try and reserve the last 30 minutes for questions. I know there's a lot of them. All right, so first steps. So let's say you're like, yes, I want to get enrolled in microfarm, or yes, I want to get started with the disaster assistance program. So no matter if it's insurance or no matter if it's disaster assistance, your first steps are going to be number one, you would need to register for a farm and track number. And number two is you would need to make sure that you are compliant with conservation programs in your area. So to register for farm and track number, that is actually a fairly simple process. Basically, what you need to do is you need to prove that you have the right to farm on the land that you're currently farming on. You need to prove that you are who you say you are. And then you would need to just provide some kind of tax information. So Social Security, if you're a sole proprietorship, employer identification number, if you have a business, and then any supporting business documentation. So that's say like me and Shannon are in a partnership together on our farm. If I go just by myself, I would need to also bring documentation that says Shannon is also a part owner. Shannon gives her permission for me to enroll in this program. So that's what that additional business documentation would be. Something else would be like if you have an LLC, any documents that you have to back that up would be that kind of business documentation. So the 80-10-26, for like most disaster assistance programs under USDA, you would need 80-10-26. For USDA loans, you would need 80-10-26. For microfarm, you do not need the 80-10-26, but you can expect to pay a lot more out of pocket if you don't have that certification. So I really strongly suggest everyone to get that 80-10-26. So if you're interested in microfarm, you would find a crop insurance agent, and then you would bring the above information to that agent. So make sure you first do those steps with Farm Service Agency, and then you bring that paperwork with you to your insurance agent. Is this registration through Farm Service Agency? Yes. So registration for farm and track number, that is through the Farm Service Agency. The 80-10-26 is also through the Farm Service Agency. So the Farm Service Agency, they're going to be county offices, like for the different counties. Massachusetts is small enough that they combine multiple counties. I think there's one in Taunton, and I think there might be one in Bristol, is your local county FSA for, I think, some of the other folks joining us from outside. So if you're from Rhode Island, the Rhode Island FSA, we just have one in Warwick because Rhode Island's very small. Connecticut, I think there's one in like New Haven. I know there's one for Hartford County. New London, I think, is one of the counties. But I'll give links to where you can search for your county a little later on. I'm going to quickly move on. Okay, so at this point, I do want to take some time to acknowledge that not everyone may want to work with the USDA. So the USDA has done a lot of really good things for farmers, but they've also like done a lot of harm as well. So throughout the USDA's history, they've honestly done a lot of quite violent things. They've practiced a lot of really discriminatory practices against farmers of color in particular. So knowing that, I can fully sympathize with why someone may say, like, why would I share with the USDA my demographic information given those things? So the reason is because, and like just a reason why you might want to consider doing so is because I think the USDA, especially in the past couple of years, has really tried to put in programs to help right those historical wrongs. And so if you self-certify your identity, you can qualify for a number of provisions. So you can get fee waivers, you get higher payments for disaster assistance, premium reductions, automatic enrollment in certain programs. USDA cannot enroll you automatically. So I cannot go into the USDA office in Warwick, Rhode Island, and they can't just look at me and be, all right, she looks Asian, we're just going to check off the box there. Like that, no, they can't do that. I have to fill out this form, CCC 860, to say that I would like to be considered a beginning woman BIPOC farmer. So just want to share that to reassure folks here. So just an example of some of those provisions. So for the NAP program, beginning in 2023, and this is new information as of literally 2 weeks ago, it is automatic basic level enrollment in all eligible crops for if you're a beginning limited resource veteran woman or BIPOC farmer. For ELAP, which is that the one for like livestock, honeybees, fish, there are higher payouts available. So rather than 75%, it's now 90%. And then for microfarm insurance, I already covered this, but there are reduced premiums available. So I think the reduction is like 10% difference. So 10% is not anything to sneeze at, right? Like 10% is fairly substantial. So because of these different provisions, I do think it's something to consider if you would like to enroll and self-certify as one of these identities. Okay, so working with USDA. When you work with USDA, you are entitled to something called a receipt for service. This service receipt is something I absolutely encourage anyone, anytime they interact with USDA, to ask for. So this will include information such as the date that you spoke with a USDA agent, who you spoke with, what they recommended you to do, and any follow-up actions that they requested you to do. And I think that this is just a really good tool to get building like a paper trail for yourself, just in case you're ever bounced to another agent, just in case there's ever a dispute, which I hope will not be the case for anyone here. But it's just a really, really good thing that I encourage all my farmers to make sure to ask your service receipt. It just really helps in case anything ever happens. Like you'll have a running list of interactions. So just something to know, you have the right to ask for a service receipt. This applies for Farm Service Agency, Natural Resource Conservation, Rural Development, Risk Management Agency. This applies to any USDA office across the board. Okay, now for working with an insurance agent. So USDA handles the disaster assistance programs. Insurance companies handle the insurance programs. I think the biggest takeaway is do not be afraid of advocating for yourself. So absolutely ask lots of questions. Absolutely find an agent that you work well with. So to go back to that car insurance example, I wouldn't go with the first car insurance company that I go with unless I really hit it off with that insurance agent, right? So I might go with Geico, but maybe the Geico programs, I don't really, it's not working out. I would be shopping around to State Farm, Allstate, Progressive. Like, you have the ability to move around and find an agency that you work well with. This program is very, very new, which means that the insurance agents themselves are still learning about this program. And I have heard that I think most agents are genuinely here to help folks. A lot of agents come from agricultural backgrounds themselves, but I do know that there are some agents who say microfarm is a more complicated program to write than a corn policy. Why would I write a microfarm policy if I could write 3 corn policies? If you start working with an agent and you find I'm not getting along with them, or they're not responding as well as I would like, that's okay. Find another agent. You cannot shop around for costs in the same way that I could with other forms of insurance, but you absolutely can shop around for service. And you want to find an agent that's going to be in your corner. You want to find an agent that understands your farm. You want to find an agent that should claim time come, they're going to be working well with you. So yeah. And in terms of agent, something to note, they do not need to be from the state that you're in. Agents can be licensed to work in various states. So you can look out of state if you need to. I see a couple of chats come in. Does it apply for NRCS too? I assume that means for the service receipt. That is, yes, it is for all branches of USDA. The service receipt, I don't know if insurance companies have something similar because they are private companies. That being said, I don't think it's ever a bad idea to note down who you talk to, the insurance agent that you talk to, the date that you talk to, the numbers. I never think it's a bad idea to kind of create that. Awesome. Cool. All right. That was all the nitty gritty. I'm going to take a pause, ask if folks need a break. I'm going to ask if there are any burning questions that we want to cover before we look at some numbers and examples of different farms and scenarios. All right, I'm just going to shoot right ahead. All right, so I'm going to show 3 examples of farms. So one example is a farm that whose revenue has stayed quite steady. I'm going to show an example of a farm whose revenues have been all over the place. And I'm going to show an example of a farm that has been steadily increasing in their revenue year after year. So let's start off here with Trailing Arbutus Farm. Trailing Arbutus is the state flower of Massachusetts. All of the farms are going to be named after the state flower, so you get to have a little bit of trivia on top of your microfarm learning today. So let's take a look here. So this farm has, for the most part, had pretty stable revenue in the past couple of years. And so their historic average is 49,000. Their expected is 55,000. So if you take the lower of these 2 numbers, their approved revenue would now be 49,000. Now we're going to take a look at the coverage levels. So we're going to take that 49,000 and multiply it by the percentage. So for 85%, $41,990. To 50%, $24,700. So indexing. So indexing was what I had shared, is that adjustment that allows you to curve upwards. They're not eligible for indexing because its revenue is not increasing overall. So sure, the burning question is, how much would it cost this farm to get insurance? So 85% coverage for the farm, if they did not have a subsidy, it would cost them $4,400. If they have the 80-10-26, that knocks the amount down quite significantly. And the producer would expect to pay $1,000, $958 for 85% coverage. Now let's take a look at the other side. So 50%. To insure $24,000, you would expect to pay less than $300. So at this point, whether or not this farmer should choose microfarm is going to depend on a number of different factors. So one farmer may say, you know what, I'm like only making $50,000 a year. So if I pay $2,000 out of pocket for insurance, that's like 4% of my year's revenue. That is way too much money. But you know what? For less than $300, if I can have like basic catastrophic level coverage of 50%, that's worth it to me. Like that helps me sleep at night. I know that I will not have total crop failure or like have a total wash one year. I can insure up to 50%. So one farmer may say that. I also want to point out here, take a look at the numbers 85% and 80%. So this is not a linear progression. So it's not like each 5% increase is the exact same amount that's increasing. So between 85%, 80%, that difference in the premium is like 40% difference. So maybe the farmer says, you know what, I'm okay paying $1,000 for 80% coverage, but I'm not, but you know, $2,000 for only a 5% bump is not worth it. So I point that out because if the 85% coverage seems to be too high, but the 50% coverage seems to be like way too low in terms of like, I don't think that's enough coverage for my farm. I would suggest folks look at those middle numbers because those middle numbers may, like the optimization between cost and coverage may be worth it for some farmers. So let's take another look. So I'm going to pick on myself. I'm coming from Providence, Rhode Island. I am Blue Violet Farm. My numbers are all over the place. So sometimes I make a lot of money, like 2021, I made $160,000. But 2020, I made $100,000 less. So in this case, this farm's revenue is going all up and down. So their historic is 104 as an average, and their expected is 170. So without adjustments, because of those bad years, that really drags down my average. So what is an option available to me? So what could happen is this. So using the approved revenue of 104, which is the lower of between my expected and my historic average, my 85% would be 88,000. So that would be the maximum amount of money I could be covered for. However, so substitution 60% is a way to curve the number. Basically what it's saying is I'm going to substitute my lowest number for 60% of the other numbers. In this case, doing that like does bump up the number a little bit, but not by too much. Exclusion says, oh, what I'm going to do is I'm just going to drop the lowest number entirely, and we're going to take the average that way. So when you do that, now your 85% is 97,000. So this 97,000 is like $9,000 more than it would have been if you had just taken a straight average. So, and this 97,000 at this point is like more than what this farm has made in 2 of the prior 5 years. So I point this out because these things, these adjustments are absolutely something that you should be asking your insurance agent to look into, and a good insurance agent should provide you quotes for different adjustments. So that's what's available here. So in this case, revenue exclusion gives the best approved revenue. The producer premium is based on your revenue exclusion. Now, let's look at our last example here. So this is Mountain Laurel Farm in New Haven, Connecticut. So in this case, this farm has been doing better and better each year. So from 2018 to 2022, they've increased their revenue by about $40,000. So if they did a straight average, that historic would be 211,000 because some of their earlier years would bring down that average. In this case, they have something called indexing. So indexing will curve that number up. So if they did not curve the number, the approved revenue would be at 211,000. With indexing, they have now curved the approved to 240, which means that their 85% coverage is now $204,000. So indexing is available to help curve the number up if you've been making more and more and more. And again, your insurance agent should be offering you this as an option and should be providing you quotes for this if your farm's been doing better and better each year. I see a question. Oh, do you all think? Thank you. You're very welcome. Glad you could join. Okay, so let's take a look at the more detailed premiums here. So this farm, so of course, looking at this, they would obviously choose the index number. So 85%, 204,000. They could expect to pay $9,000 out of pocket for $204,000. 50%, they could expect to pay $1,000 for $120,000 worth of coverage. Again, I want to point this out. So if you look at 85%, it would cost me $9,000 to enroll in this program. But for 80%, I pay $5,000. For 75%, I can expect to pay $3,000. So again, maybe this farmer decides, you know what, 50%, that seems too low. Like I'm expecting to make $240,000. Like this is only 50% of what I'm making. That's not enough. But I also don't want to pay $9,000 for 85% coverage. Some of these middle numbers could be some to consider. And I think each farm is going to have a different set of factors that they're weighing in. So let's take a look here at a couple of different scenarios. So let's take a look at scenario one. So scenario one, they ended up selecting 70% coverage. So they're insured for $168,000. During the year, they end up only making $125,000. So at the end of the year, they can submit for a claim of $43,000, which is the difference between what they produced and their coverage level. So you take the indemnity and then you subtract your premium because you have to subtract the amount that you paid out of pocket for this, right? And so they end up bringing back and recovering $40,000. And so their final revenue is $165,000. Let's take a look at scenario two. So scenario two, they have reduced $190,000. So they can put in for a difference of $14,000. In this case, the premium cost them $9,000. So they end up benefiting in total by $4,000. Okay, so in this case, yes, it didn't make them as much as it could have, but they were still able to recover more than if they had not had insurance at all. Scenario three. So in this case, they ended up producing $200,000. And so the claim, so the difference between the coverage and the revenue produced was $4,000. In this case, the premium means they ended up paying more for insurance. And so they ended up taking home $194,000, which is less than if they had not had insurance at all. And so I am including this scenario here because, like, again, I want to show you all the different things to consider and all the different possibilities that may happen throughout the year. Another thing that may happen is this. Insurance. So let's go back to the example of car insurance. I have paid car insurance for years and years and years. And like my hope, of course, is to never get in an accident. So ultimately, like in a best case scenario, insurance is always going to cost me something, but I might not be able to buy into it. But it's worth having that insurance. I also don't know. There's no way for me to know when I might end up needing to tap into that insurance. So I pay and pay and pay my car insurance and I don't see any benefit. But all of a sudden, let's say tonight, I drive and I get into this really horrific accident. I lose a limb. The other driver, God forbid, is injured. In that case, all those like all those insurance premiums I paid throughout the years, in that one instance, all of it becomes worth it. So maybe this isn't 3 farmers looking at this. Maybe this is year 1, year 2, year 3. So maybe scenario 3 is year 1, scenario 2 is year 2, scenario 3 is scenario 1 is year 3. So this case, like, even though it wasn't worth it 1 year, this really bad loss in scenario 1 makes all the other insurance payments worth it. So like, I'm sharing that to kind of just, again, like different ways of thinking about insurance and thinking about insurance being like a long-term thing to insure my farm business, because it's just really impossible to know how, like when bad years are going to happen. So scenario 4, all my strawberries are lost and my blueberries do really well. My gross revenue does not change. I cannot claim anything. So this program ensures your total revenue. So if one crop ends up making more for it, making up the difference for another crop's loss, your gross revenue may not change and you may not be able to claim anything because the gross revenue hasn't dipped below what you insured it for. In that case, as I had shared earlier, maybe your strawberries in this case are the really high value crop. You could blend it with the NAP program to insure those strawberries specifically, or to provide assistance specifically for those strawberries. That's a possibility. Scenario 5, I made $220,000, so I don't qualify for an indemnity payment. All my expenses have increased and experienced a net loss in income for the year. So in this case, so this is insuring gross revenue, but it is not insuring your profit. It cannot insure the business itself. So this is something that I just really want to point out because it's something that I know I've gotten questions about. Like, I think there's this thought of, okay, great, like this is a way for me to like guarantee that my business is going to be profitable. No, this is a way to guarantee that your revenue, like, is a way for me to predict how much I'm be able to make from my revenue, but it cannot account for any potential changes in expenses. And so it ultimately cannot guarantee that your business will be profitable. So I just want to like point that out as another consideration, another thing to be aware of when looking at this program. Okay. So that was a very quick overview of the different scenarios and a couple of different farms and just examples there. So the Carrot Project, we have created a number of self-guided tools for farmers to be able to go through this program on their own and see for themselves if they would be eligible and what pieces of paperwork they would need for their application. And so this will be available in the slides that we sent out later. I think Shannon also has the links that she could drop in the chat to have available to anyone. So we do not have enough time to go through the numbers. So this is something that I can support farmers with. I can help you go through the numbers for yourself based on your farm's, like where you're located, how much you're making, and we can go through the numbers with you and I can talk you through some of those considerations. So this is the link if you want to poke around. It is a little bit of a clunky tool. If you have questions about how to use it, you can reach out to me, or if you want someone to go through this tool with you, I'm also available. Okay, so a couple of things to consider. So I'm just going to go through here. So is my revenue likely to fall below the trigger point? So basically what this means is if I select 85% coverage, how likely is my revenue to fall 15% in the next year? That's a pretty good way to think about how likely am I to need this insurance, or how much insurance do I need? So maybe throughout all of my farm's history, I've never fallen below 20%. In that case, like 80 or 75% would be the coverage. That's all I need. So that's just something to think about. How stable has my revenue been year to year? That can influence whether or not you decide you need this program, would like to enroll in this program. Historic circumstances. So let's say the river near me floods every few years. In that case, maybe I do want to be part of this insurance program because I know every few years I experience a pretty devastating loss to my business. That can make it worth it. My crops are diversified and one does poorly based on conditions, another does better. In a situation like this, maybe I've noticed that even when I do experience losses, other things make up for it. And because of that, my revenue stays pretty stable. Someone that has this scenario may decide microfarm, they don't need it, or that this isn't the best program for them. What do my projected finances looking for the coverage year? Can I self-insure? Do I want to self-insure? So maybe instead of paying someone the amount in premiums, maybe I have an emergency fund that I'm already putting money into. In that case, if I'm able to cover damage myself, that's something to consider. Maybe that's the best option for you, so you don't have to pay someone else for it. Lastly, how comfortable with risk am I? Each person has a very different farm business, very different comfort level of risk. One farmer may say, you know what, I'm good to go. I've decided I'm just going to take the risk. I'm going to just go through with the year as is. Another farmer may say, I want the peace of mind. I'm okay paying a couple of $1,000 for the peace of mind. That's going to depend individual to individual. So to me, how comfortable with risk am I is just the question to really ask yourself. Okay. So next steps. So I'm here and available to help you go through your farm's numbers. I'm available to go through options, whether they be microfarm, disaster assistance, other programs as well. If you decide I'm ready to go, I'm ready to contact the appropriate person, these are the links that you can click on to find either an insurance agent or your local county farm service agency for the USDA programs. Okay, so in summary, number one is go through your numbers. So I really suggest making an informed decision based on what you see for your particular farm business. You can use the premium calculator to estimate out your premium. That's the link that I had shared a little while ago. All crop insurance is sold through crop insurance agents. Find an insurance agent that you work well with. Notify loss as soon as possible. Always notify loss if you think there's a possibility of impact at the end of the year. Keep strong records. You'll need to back up your claim when needed. And that's it. Thank you so much.
Thank you, Amanda. I know I've learned so many things, and I hope everyone else on the line has as well. We do have a little under 15 minutes to go through some question and answer. I have a feeling we have quite a few more questions. So while we're thinking of those, I'm just gonna, again, if you missed it in the beginning, I'm putting CMAP's survey in the chat. If you could just fill it out based on your experience with this workshop, it'll help us improve things going forward, and it makes our funders really happy. But I do want to open it up now for any questions that you all have. You can feel free to put them in the chat or raise your hand, or we have a small enough group that you can just unmute if you'd like.
How are folks feeling? I know this is incredibly detailed presentation. I know we went through a lot of like really fine details, a lot of potentially new terms, insurance jargon. How are folks feeling? Do I think the microfarm insurance program will be around in 3 years? That is a really good question. So as I shared, this program launched in 2022. This particular version of the program has only been around since October of 2022. So I think that the program is going to continue changing. To the best of my knowledge, there's been no one was enrolled in this program that I'm aware of in the Northeast. I do think it'll be around in 3 years. My understanding is that like USDA is really trying to create some form of insurance for folks who have traditionally been shut out of crop insurance. I do think in 3 years, though, the program may look different. So I think the bones will be the same, but some of those like particular like paperwork things, or like even some of the like approved revenue levels may change. So as an example, when this came out early 2022, this program was only available for folks making up to $100,000. And that was just far too low. And so this year they raised it up to $350,000. I do know that there's a strong push to raise the limit up to $500,000. So that's a really long answer to say, yes, I think it's gonna be around in 3 years. I don't think it's gonna be the exact same program though. So check back in with me in 3 years. Are agents aware of it? Are they informed? Yes, they are aware of it. Are they informed of all of the fine details? I think that they're aware of the fine details of the parent program, which is called Whole Farm Revenue Protection. However, crop insurance agents have not traditionally worked with small scale, very diverse farmers. And so I think that there is going to be like a period of them learning about these farms. I do think something to be aware of is because they better know the whole farm parent program, they may ask for things far beyond what you actually are required for micro farms. So like, for example, whole farm is going to ask you to present like every single crop and exactly how much you made for every single crop. Whereas micro farm is just going to say, as long as you give me like a weekly tally or like a monthly sales record, that's good enough. It's things like that that I think are going to be something for farmers to advocate for themselves. If they think that like, hey, this is way more than Amanda Chang shared, definitely ask them, hey, like, are you sure this is for micro farm or is this something for whole farm? So again, I give very long-winded answers. Yes, they're aware of it. I do think that you should advocate for yourself and make sure that they're going by the micro farm rules and not the whole farm rules. They're mostly similar. If anything, micro farm is just less. There's less requirements. It's a simpler program overall. But good question. Thank you. Any other questions?
I have a
Yes.
couple questions. So I have two things. We had a name change and a structural change at the same time. So we were sole proprietorship under one name. And then in 2019, we switched names and went to LLC. And in our taxes, we file as an S Corp, even though we're an LLC. So we previously filled out Schedule F, but we don't anymore. But you mentioned early that you could have a substitute schedule, like if we still have our CPA fill out a Schedule F, that would work.
So the substitute Schedule F, you do not need to fill it out on your own.
Okay.
The insurance agent is going to be the one to fill it out. So what that means is as long as you can provide equivalent, like enough information for them to fill out a substitute Schedule F, that's good enough. I do want to ask though, so in this case, like you've changed your business structure, you've changed things. Is it still the same farm? Is it still like the same production? Essentially, it's just purely like a business legal change.
Yeah, same farm, same farmers, everything is the same. It's literally, we went to an LLC, we went to a business class. And what came out of the business class is a change in name, and the going to an LLC to have a little more protection. But it's me and my husband, it's like everything else is the same.
Got it. Yeah. So yeah, in that case, I think that substitute Schedule F I think that should be fine. That would be fine.
Okay.
Yep. Good questions, everyone.
Good talk. It's even better the second time.
Oh, thank you.
Because then I can start like keying in on, I'm like, oh yeah. What I realized is that we have, I think as most diversified farms have done, is we've built in our own insurance because we've been cut out of the system. And in so many cases, one thing doesn't do well and other things do well, and it makes up for it. But we have chickens and I'm super worried about if we lost our flock, we'd go out of business. So like, that's one thing. So I'm looking at like the catastrophic and what happens if, we're also right next to the ocean. So hurricanes and avian flu right now is what we're kind of nervous about.
Yeah. And that's like, so if we had enough time, I was going to talk about like like comparing and contrasting, or like questions to ask yourself. And so just in general, what we're saying at the Carrot Project is, even if you've never needed external support, or you've never considered external support via USDA insurance or disaster assistance programs or whatever, we do think that the way things are happening with climate change, I do think that like the risk to farm businesses is increasing, and it's something to start really considering. So even if you've never needed it in the past, like maybe previously, like you didn't lose all your crops at once, or like storms weren't as extreme or droughts weren't as extreme. Because of that, like we do think that these programs really are something for farmers to like really consider now. That's what we're really saying, and is something that I really strongly believe in.
Yeah, it's also as we get further, so we're heading into year 12. As we get further along in this journey, you know, making it year to year is more important. We've got, you know, sometimes we have 12 seasonal employees, and we've got, you know, a tractor loan and a USDA microloan. And so just the consequences of loss are much bigger than they used to be. So like my risk aversion has changed as the farm is growing up.
Mm-hmm.
So this is coming along perfect time, because I'm getting less risk adverse.
Great.
Or no, more risk averse. Yeah.
Yeah.
I saw something, Amanda, about the threshold moving up to $400,000 as a farm grows, you know, multiple years into insurance coverage. Can you speak at all to a farm in a period of growth who's nearing that $350,000 threshold, and what that means for their participation in the program?
Yeah. So if you are previously enrolled in microfarm, and next year you make more, your threshold can be increased, as you said. I believe, yeah, to that like $400,000 limit, because ultimately, like they are trying to encourage folks to reduce, and they're like not trying to punish anyone by like keeping you below $350,000, right? So like that is something that's available to like curve it up. That would be a pretty cool change if they could keep like curving it up as the years go on. That being said, the whole farm revenue protection program is another program. So if you get big enough, like kicking over to the parent program allows you to open up to insurance up to like 17 million. So if you start getting into like the hundreds and hundreds of thousands, into the millions, that program is something that you could look into. And like that program, yes, it comes with like higher record keeping requirements and like more things that you need to like provide the insurance agent, but it also comes with additional perks. If you can also purchase, like enroll in additional crop insurance programs. So like as you get bigger and bigger, there might be like one or two high value crops that like the NAP program under USDA doesn't cover enough of. So you want something from a private insurance agency, like that could be something to consider. So if you're in that stage of like increasing, that's also something that you would be talking to with your insurance agent, because the insurance agent is going to better know all the additional things that they have available to support you as you're growing. But I am curious to see, like, as microfarm like becomes more and more established, if that's something that they're going to continue changing and like adding on. Great questions.
All right, there's definitely still a little bit of time to throw some more questions in the chat. But Amanda and I were curious, you know, if a continuation of this conversation that got more into the tax specifics would be something that you all would be interested in. And I don't know, Amanda, if you want to tell a little bit more about a possible continuation of this.
Yeah. And in terms of recording too, like I can talk about that. And also like, I don't know if some folks like might want to just like ask questions like off recording if they're like more personal questions. So I just want to like, I can stay on for a little bit afterwards. So in terms of like, if this is something you're interested in, like looking at how you would do your farm taxes or any tax considerations or record keeping considerations, or like how you would need to like any additional financial record keeping or production record keeping you would need to like remain in this program and be able to place a claim and have it and be able to place a claim and have that claim be approved. Those are all things that like we have provided programming on. So for this particular program, this is actually like a reduced part of a larger program that we've run in the past, but we were just wondering if like an extended version is something that folks would be interested in.
So if yes, just give a little thumbs up or note in the chat or come on video, or just let us know, or, you know, sit with it, think with it. You'll have both me and Amanda's contact information. So you can follow up with either of us or both of us if that's something you might be interested in.
I would be interested in it. I've got to run though. It's swim class time. For the miniature human has swim class. Thank you all
Yeah,
for coming.
Thank you, everyone.
Thank
I'm
you.
stopping recording now.